Hello, this is Steve St. Angelo, once again from the SRS Rock Report, and I'm glad to be here today because I'm going to do a shorter update on extension of the last video on what the gold and silver setup today, which is still bottoming. I'm not talking on a daily or weekly basis, I'm talking on a long-term basis, compared to what it was in 2008, which was, it was very overbought. Now, gold and silver were also overbought on a technical aspect in 2011, but I do believe we're in a much different situation today, so let's get started. Now, the comment I received the most in the YouTube in the video, the last video, and I don't read all the comments, I'm sorry, but the one that I did see a lot was that some people didn't think there was such thing as a 200-month moving average, and there is, and I'm going to explain why. Now, this is stock charts, which I use. They're a great service. And right here, it shows daily chart. And each one of these candles represents a day of trading. And as we can see, it's 1 year. Now, when you have a daily chart, you have a 200-day moving average, which is in red, and a 50-day moving average, which is in blue. And right now, it shows you that the 50-day moving average is $15.70 with the silver price way down here. Now, when we have a weekly chart, and this is a 5-year chart from 2013 to 2018, when you have a weekly chart, then we have a 200-week moving average and a 50-week moving average. Now, because these prices, these trend lines are on top of each other, we can see them right here. The moving average, the 50-week moving average is 1650. Now, when we have a monthly chart, then we have a 50-month moving average and a 200-month moving average. Now, in order to have a 200-month moving average, you divide by 12, it's almost 17 years. You have to have trading for 17 years to have a 20-month moving average, but there's such a thing. Now, what's interesting, as I've shown you in the previous video, look how the trading has been going right to the 50-month moving average. Now it's broken below it, and they say this is bearish. Now, it is bearish, but the problem is the metals have been selling off and getting closer to their base, which is the 200-month moving average, different than the markets. But if we look at the 50-month moving average, the price is $16.65. Now let's go back to the daily. Now you see, because the daily is moving much more quickly and down, the price is much lower. It's almost $1 lower. So the different daily, weekly, and monthly, they have different averages, even though they could be close. Now the gold price is similar to the silver price. After the gold price peaked, it consolidated, and now we're at around the 1200 mark. And the 50-month moving average, and right now, again, this is a monthly chart, 20 years, is $1,233, and the 200-month moving average is right here, $984. So gold has fallen below its blue 50-month moving average, but it's still above its 200-month moving average. Now, if we go back to 2008, look how much higher gold was. It's the same thing with silver. Silver was extremely overbought. And so when the markets crashed, it came down. Now, right now, silver is not overbought. It's now becoming oversold. Same thing, even though gold is not close to its 200-month moving average, I don't see it crashing like it did in 2008. Now, who agrees with me, and I've been following his work, is Keith Weiner of Monetary Metals. And if you've been looking at his work, this is an article that was on Zero Hedge. In the next crisis, gold won't drop like 2008. And what he says is that Keith sat at a table with a hedge fund trader. The trader does not think gold is money. It is not, he's not into gold, other than that being a trade along with other asset classes. And probably he would not describe himself either as a libertarian or Austrian School of Economics. However, he's very smart and does a very good job at what he does. Now, he shared that he had recently been with a group of his peers, and they were all discussing the monetary system. As he presented the consensus of the group, a thought struck with Keith. Now, this is what Keith says that this hedge fund trader was saying. After the crisis of 2008, the central banks lowered interest rates, enabling governments and everyone else to go deeper into debt. However, that debt is now a problem. I've been talking about that in several articles and interviews. These traders' view is that gold is going down and it will continue to go down, and then we're heading into a repeat of 2008, especially this time will be worse. The next crisis will be a debt crisis, including sovereign debt. Like in 2008, every asset will go down. Gold will go down with all other assets, although less. Afterward, gold will rocket up 10 or 15 times or 50 times. Now, he's saying these aren't gold bugs talking about 12,000 and 60,000 gold price, but conventional finance guys. They are positioning themselves now for this kind of move already, as they don't know the timing. Now, this is an extension lower down in the article, and this is the differences between now and then. And I totally agree with Keith on this. Now, if the crisis occurs this year, and a good chance will be this fall, we can already see obvious difference. There has not been a dollar bear market, which is miscalled a gold bull market, running for 7 years. Gold is not in favor in the mainstream media. If it were, the gold price would have not been sliding since the peak of 2011. And from this, we can draw 3 inferences. 1, today gold is less held for speculation than March 2008. 2, where it is held for speculation, the holders likely have hedges to protect them from downside price risk. And 3, gold is probably held less in highly leveraged portfolios than it was last time. Now, another difference this time, everyone thinks they know how it will play out. Back in the fall of 2008 and early 2009, no one knew the Fed and other central banks were about to do. Today, the glib phrase is print money to infinity rolls off everyone's lips, not just those in the gold community. And they know that first gold will go down and then skyrocket. Now, the last time the Fed printed $3.5 trillion, next time everyone knows it's going to be 10 times, 35 trillion or whatever it takes. So they know gold will go down, and then they know it will be the buying opportunity of a lifetime. However, gold this time is coming off a 7-year bear market, not a 7-year bull market. And there is one other difference today. Everyone is much more aware of the dangers of the counterparty risk and the solvency questioning hanging over the banking system. This does not have to be learned, new, or over a period of months like it did last time. People are also thinking about cash bans, capital controls, and other factors that make gold relatively more attractive. These were inconceivable in March 2008. Now, it is possible at this time the price does not dip very much or at all. We are not going to try to predict, or perhaps we should use scare quotes, predict what will happen to the gold price in the next crisis. However, we would not hold our breath for gold to hit 830, which is a 30% drop from today's price. We say this, we cannot think of any gold bearish differences between now and 2008. The differences are all gold bullish by comparison. Now, again, the difference between the precious metals and the broader markets and most of the stocks in the broader markets is that the gold price and the silver price moved up, peaked, and they've been consolidating back to their 200-month moving average. Again, this is a monthly chart, so we have a 200-month moving average. Now, all the indexes, the S&P, the Dow Jones, and the NASDAQ have been moving up higher, way higher above. And now the Dow Jones peaked the beginning of 2018, sold off, and now it's trying to hit that peak again. But the 200-month moving average is 13,531. The 50-month moving average is 19,848. So now the Dow Jones is almost 90% above its 200-month moving average. And I said the NASDAQ in my prior video was 145%. So these are still primed for a massive sell-off. And when I say this information, this is, again, this is not for investing. This is information for educational only. But when you look at what's happening, this is not something that's going to happen this week or tomorrow or this week or next month. But when they start to change, it's a long trend change. Now, I wanted to show this chart because there is a big dislocation that took place from the 1994 to 2000. Now, this is the Dow Jones gold ratio, and it's very simple. We take the Dow Jones index and divide it by the gold price. And right now, we get 21.3. So the Dow Jones index can buy 21.3 ounces of gold. Now, if we go all the way back to 1981, this is again a monthly chart, you could buy only 2.5 ounces of gold. 12 years later, it was 10 ounces because the price of gold declined, but it stayed in the 200, 300 range, but the Dow Jones shot up. Now, what really happened from 94 to 2000, the gold price didn't increase, but the Dow Jones did. So you could buy 40 ounces of gold right here. Now, it did spike up past 42, but right in this area, it was 40 to 1. And then as the gold price took off, the gold ratio, Dow Jones gold ratio fell, and it fell to a low of 7.5 right here in this period. It did hit a low of 6 in 2011 when gold reached a price of 1900. But then as the gold price sold off, it started to go back up. So now we're at this current 21.3. Now, if you think that's high, take a look at the silver ratio. The gold silver ratio was 100 to 1 back in 1981. And in those 12 years, it shot up to 1,000. So you could buy 1,000 ounces of silver to the Dow Jones. And as I mentioned in gold, the same thing happened with the silver. When it reached its peak here in about 2001, you could buy 2,500 ounces of silver for the Dow Jones. But with gold, when the silver price increased and shot up to 50, right here in 2011, it was 300 to 1. And then as the silver price sold off, now we're at 1,740. When the markets start to correct, the Dow Jones goes lower. We're going to see this number ratio, the Dow Jones silver and gold ratio, start heading lower. And I believe we're going to see come back to this 100 to 1 ratio. So again, I just wanted to show you this chart that the silver price was very overbought here during the market crash. So it could fall from 20 down to in the 8-9 range. Well, look where we're at now. We've been selling off and consolidating for the last 7 years. So even though it's below here, it's much closer to its low than the other indexes are. Now, one of the last charts is this is silver Wheaton, which is now Wheaton Precious Metals. All I wanted to show you was that this is the kind of explosion in the precious metal miners I think we're going to see at the same time like we did in 2009 to 2011. And in 2009, I remember 2008, 2009, silver Wheaton was trading at $2.50. And in 2 to 3 years, it hit a high of 40. That was a massive increase. Now it's been selling off. And now here, this is an important thing to see. This is the 50-month moving average. But because Wheaton Precious Metals only started trading in 2005, it's only been trading for about 13 years, 14 years. That's why we don't see a 200-month moving average in red. Whoops. It needed to be trading back here to have a 200-month moving average show up here. So that's why there is such thing as a 200-month moving average. Again, I think we're going to see a setup here when the market's correct. We're going to see the metals turn around, and as well as the miners. Now, I'm going to conclude by saying I do believe we're in a much different setup today. Just as Keith Weiner said, he's excellent at looking at what's happening on a more technical daily level and knowing what's happening with the financial guys. I do believe it's going to be a disconnect. as it happened in 2016 when the Dow Jones sold off 2,000 points. It was the second highest record of retail gold flows into ETFs. People were very nervous. This time around, when we have the correct, we're going to see that same kind of buying. So I wanted to thank you for watching this update. And if you haven't already subscribed to the SRS Rock Report YouTube channel, please consider doing so. And I wanted to thank you again for your time, and have a good day.